Hello, good morning. You're watching Buy Now, Sell Now on ET Now with me, Vinny Motiwala, along with me, Shrishti Sharma as well. Shrishti, a very good morning to you. But Nifty, nothing good coming in terms of the mornings over there for the D Street. And that's a bit of a worry there because Infosys as well as HUL both have reported a weak number. So that's dragging the Nifty down. But we are joined by the management of Persistent System. We're joined by Sandeep Kalra, who is the Executive Director and CEO of the company. And we will be discussing a lot of things in terms of the ramp-ups, ramp-downs, impacting the execution, the margins that we're expecting going forward as well. Thank you so much, sir, for joining in with us this morning on ET Now. And obviously, I want to just start by talking in terms of the CC revenue growth that has come in. 2.9% versus the estimate of 3.5% on a quarter-on-quarter basis. So, is this broad-based ramp down that is something that is impacting the execution of the company? What is it that we could understand from this?
So if we were to look at our overall results, the Q1 came in at 282.9%, which is a very healthy growth of 3% quarter-on-quarter, 17.1% year-on-year. This is dollar basis. In rupee terms, it is 3% quarter-on-quarter, 23.6% year-on-year basis. And please keep this performance in the relative context of the macroeconomic environment. I'm sure you are talking to other peers of ours in the industry as well. And this growth is relatively on the higher end of the growth curve, if you may consider that. Now, as far as we are concerned, there are always going to be puts and takes. In a macroeconomic environment like this, there is going to be new inflow and there's going to be some delays in execution, which basically are from the customer side. So we have seen a mix of that, but we are very happy with what we have delivered at the end of the quarter. The 3% is pretty much in line with what we were expecting to deliver.
Okay. Hi, very good morning, Sandeep. This is Shrishti joining in. So, on your guidance, so is it fair to say that you will be at the lower end of your 3 to 4% quarterly growth outlook?
So look, we don't give forward-looking guidance. We had said that the range would be in good quarters 3 to 5%, in bad quarters between 2 to 4%. And look, we are trying our best within the hand that is given to us from a macro environment to deliver the best. And please keep in mind, this is the 13th sequential quarter of revenue growth and profit stabilization or profit growth for us. And for the last 2 years, sequentially, we have delivered 35% year on year. And the environment was different at that time. The environment is different. Whatever is the best possible in this environment, we are committed to delivering that. And that is reflected in our 3% growth compared to the industry from a quarter-on-quarter perspective.
Right, also just in terms of deal wins, was a bit lower in terms of 10% on a quarter-on-quarter basis, quite different versus your peers. What has exactly happened over here, and what's the sustainable deal number that we could expect from the company?
So from our perspective, look, if we look at year on year, the order book is a tad bit higher. If we look on quarter to quarter, yeah, it is a tad bit lower. But look, the quarter on quarter, there will be some variations. There was some delays in some of the deal wins. And please keep in mind, 80% of our revenue roughly comes from the US, where the first week of July was a long weekend. People usually club the last week of June with that. So there are small things here or there. If you ask me, are we worried about it? We are not worried about it. A little bit moving from one quarter to the other from a deal win booking perspective, that will always happen. So no worries on that front. And we are pretty reasonably confident. We are cautiously optimistic of our growth journey and we stay committed to that.
So that means you're optimistic. You say that you're optimistic and confident about the growth. So then what is making you worried, Sandeep? What's your expectation on the recovery and when do you see this bottoming out?
So if you look at even our own journey, if you look at the last 13 quarters, there have been several quarters where the growth was higher than what we have delivered this quarter. Obviously, that was a different macroeconomic environment. What we are trying to figure out in all this macro is, where does this start coming back into an accelerated growth? Now, in our discussions with our customers, they live in the same world. They are seeing the same kind of environment for their own revenues. And from our conversations with our customers and prospects, we believe in the next 1 to 2 quarters, they should bottom out and then the acceleration again will happen for them in terms of their revenues and hence ours. Today, most of the deals that we are fighting are on cost optimization. So that is where it is.
Also, just want to understand in terms of the margin miss, there was a miss in this quarter as well. What has led to this weakness? And in terms of margins going forward, what should we be expecting? What's the outlook?
I don't think it is a miss. So let me give you the margin walk. So we were at 15.4% from an EBIT perspective. Now, if you look at what we have delivered is 14.9%. Seasonally, if you were to compare the quarter with the earlier year, same quarters, you will find the same seasonality. There is a visa expense that comes in, which is for us this time about 40 basis points. There's a little bit more amortization that is there because of our own factors. And there's a very tad bit 10 basis points on doubtful debt that we have provisioned, being a conservative company. So that is what gives you the walk from 15.4 to 14.9%. Now, also keep in mind, we are one company among our peers where we have not deferred any joining of anyone in the company. We have already gone and implemented salary increments for our employees. We have done 7.5% average increase starting July 1st, which is our cycle. In India, we have done roughly about 3.5 to 4% globally in different geographies, depending on where it is. So from our perspective, we are delivering these margins on operational basis. We are not delivering these margins by cutting any, salary increments or deferring salary increments and so on. So operationally, I'm very proud of what we are delivering, and I'm pretty confident this is a stable margin, which we can obviously in the medium term, we are committed to improving it.
Again, Sandeep, when you say that in the medium term you are committed to improve, so when you say that you're positive about the margins, are you aiming to get closer to 16% of the EBIT margin band by the end of this year? Should we expect this?
So look, we have said consistently over the last several quarters, our aspiration over the medium term, which is the next 2 to 3 years, is to take our margin up at 200 to 300 basis points. Now, in the shorter run, with the macro where it is, we don't want to cut back on our investments. We'll definitely do cost optimizations wherever they are due, but we are not hung up on improving our margin in the next 1, 2, 3 quarters. We are more focused on making sure we focus on the growth. Growth is always difficult to get. Cutting cost and achieving margins, defraying or delaying, employee salaries and achieving margins, that is all very easy to do. Consistent growth is where the difficulty is. That is where we are committed, and that's where we are focused. So in the shorter run, we are basically embracing for the same margin, but consistent growth. In the medium to longer term, 200 to 300 basis points is where we are aspirationally going, and that is where we are committed to delivering. That's the situation on the margin front.
Could you also just give us some insight in terms of how various verticals and geographies are doing, whether the BFSI, even the geography-wise, the US and the Europe market, how is that doing?
Yeah, so from our verticals perspective, look, we will be a little cautious on BFSI. We are bullish on the tech companies that we have, the emerging verticals that we have, which are consumer, media, and so on. We are bullish on the healthcare life sciences, although this quarter was a slight dip in healthcare because of one particular customer adjusting their spend. They had a huge uptick in the COVID times. They are in the instrumentation space. And barring that, we are pretty bullish on the healthcare segment as well. So tad bit cautious on BFSI. Rest we are pretty reasonably bullish on. In terms of geographies, US is our biggest market, continues to do well. Europe is a smaller market, so slight fluctuations can make a difference. But Europe has seen reasonably good pipeline. Even in rest of the world, we are seeing good pipeline. So we'll be more bullish on the verticals, as I talked about, technology companies, intersection with US and so on.
Right. Thank you so much, sir, for joining in with us this morning on ETR, giving us an understanding on what we should be expecting from the company going forward as well. That was the management of Persistent Systems for y'all, the Executive Director and CEO, Mr. Kalra for y'all. But on that note, viewers, we're going to sip into a very short break. Don't go anywhere. We'll be back with more after this break.
Welcome back. You're watching Buy Now, Sell Now, and switching to some of the earning less shift focus to Ashok Leyland numbers. And what a stellar set that the company has reported this time around, a beat across the all parameters. And that's why you are seeing the sharp surge coming in on the stock, wherein the margins have come in once again at a double digit, because back in Q4, the margins were clocked in at 11%. We were hoping this time that the margins should shrink to 8.5% on the back of the pre-buying that we have seen in the last quarter itself. So this time the volumes have seen a sharp decline on a sequential basis. On the back of that, not a great set of numbers were expected from Ashok Ashok Leyland, but what a beat, especially on the margin figure as well as on the profit figure. The expectation was 344 crores, but look at the screen, the company has reported almost double to that number. 576 odd crores is what the company has reported. A beat on the revenue as well as EBITDA number is also coming in front. One particular highlight is what I'm seeing into the numbers is that onto their tax expense, there has been a deferred tax credit of 167.5 crores. So that's why their tax expense has come in lower. Maybe this number has helped their overall profit number to grow in. But if you look at the operational margin figure, that has also come in quite significantly up to what we were expecting, and that's why Ashok Leyland numbers are way better than what Street was penciling in, and 2.5% gain is what you are seeing onto the screen. So that was about Ashok Leyland. A sharp surge is what we are seeing on the other counters. Definitely other companies like M&M, Tata Motors as well as Eicher Motors, VECV, after the performance of Ashok Leyland, they will also try and get some cues, and we'll also hope that these companies also deliver better numbers than expected.
Absolutely, Shrishti. Surely we are keeping an eye out on that as well. So Ashok Leyland today, thumbs up even coming in from the street. You can see the stock is buzzing in trade as well. It went up as much as 2.45% in trade as well. Now also holding on to around those levels of gains. But on that note, viewers, we're going to get started with all your stock related queries. And for those who are tuning in for the first time, you can send us all your stock related queries and you can WhatsApp us on the number that is flashing on your screen as well. Also, you can send it to us any of your queries on the ET Now Twitter page as well. So do start sending us all your queries. And our guests for today, we have Kunal Bothra as well as Vikas Sethi joining in with us to solve all your stock related queries. A very good morning, gentlemen. Kunal as well as Vikas for joining in with us. And Kunal, I'm going to get started with the first query that is coming your way. It's from Akshay from Bangalore. And this one is they're asking on SBI, they're making 100% profit on this. Now, they're saying that, the PSU Bank Index ETF, is that something that they should, book out profits in SBI and look at buying that for the next 15 to 18 months if they're looking at something like that?
I think you should hold on to, the PSU banking stocks. I'm not sure whether SBI is the only stock which you have in your portfolio, but if you are having a mix of the smaller, the mid cap as well as the large cap PSU banking names, I think it's a good mix to hold on to for the PSU banking index. I'm extremely bullish on the sector if you ask me from my view. My sense is that these PSU banking stocks are getting into a strong second wave of a breakout for themselves, something which started off in mid of 2022 or rather in the second half of 2022 and then followed by 3-4 months of consolidation. So if you ask me, I would be extremely bullish on the PSU banking stocks, and I believe that there could be a significant upside for many of these names from the large cap as well as the mid cap PSU banking stocks. So I would suggest a hold if your time frame is 1 year plus for these PSU banking stocks.
Okay, so that's the take coming in on the PSU banking names. But moving on, and the next question, Vikas, is coming from Ayush. He has two counters in his portfolio. Firstly is KPR Mills as well as Gabriel India. He's sitting at a slight profit in both of these counters and wants to know that maybe in the next 6 to 12 months, what sort of a potential upside he can expect from both of these.
Yeah, Vinny, as far as KPR Mill is concerned, it's a quality textile stock which has its own retail brands. As far as the hosiery business is concerned, they have their own athleisure segment also. Plus, this company also owns a sugar mill, so they're also into sugar and ethanol, and a quality company with a pretty solid fundamentals. So I would maintain a hold at the current levels, and I think from here on we could easily see an upside of 20 to 25% over the next 1 year. So my advice to the investor would be to hold on to KPR Mills. And as far as Gabriel India is concerned, again, one of the very good quality companies from the auto component space, and the space looks good, particularly because of the interest of most of these auto component companies in the electric vehicles component segment. So I think this stock also can be held on to, and I think one could easily see a return of 15 to 20% over the next 9 to 12 months on this.
Right, Vikas. Surely, and that was Shrishti, my co-anchor Shrishti today with me as well, and this side is Vinny. But Kunal, the next one for you, and this one is on TTML. Now, Poonam is holding 700 shares of TTML at an average rate of 88 rupees per share. Can they look to average, or what should they be doing now?
So you can hold on to the stock as of now, but it's a very high beta name, and we've seen historically that the stock has moved into phases where it's gone 10x in a very short span of time, and then corrected also by more than 50% to 60%, in fact more, over a short span of time. So that volatility is one part which you have to take note of. For TTML, the breakout for the stock is on a quarterly chart. So over the last 3 quarters, the stock made a high which was 93.5 and a low which was closer to 49.50 levels for TTML. Now it's coming close to that 93 level. So I would expect that if the breakout happens for TTML, say in the next 1 to 3 months, then we can expect a big up move coming into the stock price. So in the anticipation that the stock would break out of that 93 levels, I would suggest a hold.
Okay, moving on, and Kunal, once again coming to you because K. Partha Sarthi wants a technical view on 2 IT names. The 2 counters are firstly is Infosys seeing a big drop in today's trading session. But he has purchased 50 shares from a price of 1150 rupees. The other one is 50 shares of Tech Mahindra from a price of 1100 rupees. He is a long-term investor and wants to know, after the sharp fall in what we are seeing in all these IT names today, what to do next.
So my sense is that we could now be at the cusp of an ending correction for these IT names. By that I mean that possibly in the next 3 months or 4 months or so, the stocks would get into a drag. They would get into a mild correction from where they are today, and that could be actually a good level to try and go contra or buy these stocks. So your strategy should be to go long or to stay long into both of these names, Infosys as well as Tech Mahindra. If possible, you can look to add even TCS if the stock corrects on dips. I would suggest to hold on to these stocks from a long-term play, assuming if a time frame is 2 years plus for these large cap IT names. So I think the next 1 to 4 months, you could get very good opportunity to try and buy these stocks at lower levels.
Okay. Because the next one we have is from Venkat Ramani from Bangalore, and they want to know a fundamental view that you have on Laurus Labs if they're looking for a time period of 12 months to 18 months holding period.
Now, again, as far as Laurus Labs is concerned, it's a good quality pharma stock and trades at reasonable valuations when you look at it in comparison to its peers. Quality pharma company, which I think at the current levels should be held on to, and I think we could see substantial upside in the coming quarters, coming months. So I would maintain a hold at the current levels.
Okay, that's a hold coming in on Laurus Labs. But moving on, and the next question, Vikas, is on Jet Airways. The viewer is from Trivandrum. He didn't mention his name, but he has bought 800 shares of Jet Airways from a price of 88 rupees at a huge loss right now. What to do next? Any hopes on recovery?
And again, these kind of stocks should be at least avoided by retail investors. The stock went to highs close to say 100 rupees when there were talks that one group by the name of Murarilal Jalan would take over this company and the airline would get started. But I think it's very risky. So I would not advise the investor to stay with such kind of a stock when there are ample opportunities in the markets elsewhere. So my advice to him would be to exit the stock at every rise if he can, or if he can try to book losses at the current levels also. I think it would be prudent, and then I would advise him to switch to a good quality second rank PSU stock, PSU banking stock, because I remain bullish on the banking sector. And from there, I think PSU banks, the results of some of them have already been out. Yesterday, we'd seen Union Bank of India. I think most of the PSU banking stocks would come out with fantastic results for this quarter. So that could be a sector where he could switch on to.
Okay. Kunal, this next one is coming in from Deepak from San Diego, and they have 100 shares of Tube Investment at around a price of 2,450 rupees per share. If they want to look to add more, at what level should they look to add more? And also, Vikas, they will want your fundamental view as well. So first, Kunal, you take it across, and then we'll get the fundamental view from Vikas as well.
So I think at 3,200 approximately where the stock is trading right now, I would suggest a hold. The stock has been doing exceptionally well. 3 years back, the stock was almost at 300 odd rupees, and from there it's moved on to 3,000 plus levels, which means the stock has given excellent returns. And the manner in which the stock has given those returns is also quite commendable. It's formed a pattern of higher highs and higher lows across various time frame over the last 3 years as well as over the last many years prior to that. So I would suggest a hold. I don't see any major reason why you should look to exit the stock at current levels.
And Vikas, what's your view on this as well? Tube investments, should the viewer look to hold it for a long period of time?
Yeah, again, I concur with Kunal. It's an excellent company. The stock has given tremendous, fabulous returns over the last 2-3 years, and I think it will continue to do so. So it's a great company, and fundamentals are pretty solid. If you look at their quarterly performance, also they've been doing exceptionally well over the last few quarters, and I think similar kind of performance should be expected from this company going ahead. So my advice to the investor would be to continue to hold on to this stock. And I'm sure we can easily see an upside of 20 to 25% over the next 1 year on this stock.
Okay, moving on, and Vikas, the next query is on West Coast Paper. Kasi from Tamil Nadu has been holding 1500 shares of West Coast Paper from a price of 483 rupees. It's just at the current market price where he entered, but I believe that his buying is quite long dated because he's been writing to us for quite some days now. So what is the medium term outlook on this one? Should he continue to hold on, and can he add more at current levels?
Yeah, Vinny, I remain bullish on the stock. I like the sector also as a whole, and most of the stocks from the sector have not been doing well of late. They've been languishing, but I think paper as a sector would do well. We've seen over the last, say, year or so, they've come out with fabulous results. Paper prices have gone up. And then the kind of demand which is being witnessed because of the demand from the organized retail space. And I think this sector would do well. And one more trigger which could be there would be the new education policy, which the government is serious about. I think one that's passed or that's implemented, then there could be a huge demand for writing and printing paper, and this company is very well positioned to capitalize on that. So I think at the current levels, he can add to his holdings and reduce his cost of acquisition. And I think from here on, we can see substantial upside in the coming months.
Okay, but moving on, let's shift focus once again to Ashok Leyland, because this particular counter is seeing no stopping, especially after the numbers. So let's get in an analyst take. How is he looking at the numbers right now? Onto the show, we are being joined by Aditya Velekar, Senior Research Analyst at Axis Securities. Hi, very good morning, Aditya. Thank you so much for your time. Firstly, what's your first take on Ashok Leyland? Because the markets were penciling in a single-digit margin figure this time around. The company has once again and continued the momentum of posting double-digit margin figure. How surprised are you? What's your first take on this one?
Yeah, good morning. So results are quite good, means we are surprised. So net sales is largely in line. The top line is in line, but there is a good amount of beat on EBITDA, and PAT also has beaten our expectations. So a good set of results. Top line is in line. So the raw material costs have come down, and as a result, the EBITDA has beaten our estimates. And then also the depreciation is down, and overall the PAT has increased because there was some tax credit, and other income is also up. So all these factors contributed to a bit at EBITDA and PAT level. Gross margins are a positive surprise. So the main driver of positive surprise is the gross margins, which have improved from 24% to 26%. So I guess the raw material benefits which were expected because of the fall in the commodity prices, that has kicked in this quarter, and that's a positive surprise in this time.
Prices coming down, that must have kicked in. But Aditya, there was also a deferred tax credit, like you were mentioning, of 167 crores. Was this amount that you guys were already factoring in, or is this coming in at a surprise? And that's maybe we are seeing such a good jump onto the profit figure, because the expectation was somewhat around 350 odd crores. The company has delivered more than 500 crores in the bottom line. So what's your take on this?
That honestly, and even the consensus was not factoring that, so that's a surprise. We will have to see so management call is on Monday at 3 p.m. So we will have to see how they comment on that factor.
So deferred tax credit of 167.5 crores is coming at a surprise, is what Aditya is highlighting. But another thing, Aditya, is what we are getting from the dealer check is that Ashok Leyland as a company has been gaining market share, especially in the north and the eastern. They are trying to increase their footprint. What's your check on this? Because the company has already made clear that going ahead, gaining market share will be their key focus. So how do you see this? And given the whole scenario right now, what will be your pecking order, because Ashok Leyland as a stock has run up quite a lot, especially after the recent analyst meet where the company shared a bullish guidance, especially in terms of the market share. Ashok Leyland, Eicher Motors, VECV as well as Tata Motors, how do you see the competitors now performing going ahead?
Yeah, so Ashok Leyland is definitely outperforming with its MHCV segment vis-a-vis Tata. So their MHCV segment is doing really well, and they have been consistently gaining market share. So you are right that they are focusing on the regions where they were usually weak, that is north and east. So their strategy is to penetrate more in those regions, and they have multiple launches, multiple fuel options. So they have in their investor presentation given a complete overview of how they are going to build their portfolio, their launches, their regions, their exports. So that things are mostly factored in. What we have to see now in the con call is what they comment on the sustainability of this CV upcycle, whether this extends in FY25 and how strong it will be. So that will be the street looking at, and if that persists, the CV upcycle persists, then the stock will have further upside potential.
Thank you so much, Aditya, for your take on Ashok Leyland. We'll definitely talk to the management and try to find out more answers on this one. But for this time, what a great set being reported by Ashok Leyland. A couple of things coming in as a surprise, especially the deferred tax amount. But overall, the operational performance looks quite strong. And that's why you are seeing the stock trading in the green right now with the gains of 2.5%. But with this, viewers, it's time to slip into a short break. But don't go anywhere. We'll be right back with more.
Welcome back, and you're watching Buy Now Sell Now on ET Now. Let me just mark the flashes on your screen where you're seeing that Federal Bank has actually approved raising of funds via issue of debt instrument of up to 8,000 crores. Today was the board meeting, and this is what they've approved. So keeping an eye out on that. As of now, Federal Bank is down almost 2% in a trade. But let's move on and keep it going with all your stock-related queries, and keeping it going with the next query because the next query is coming for you, and this one is from Pradeep from Kolkata. He's a senior citizen. They have a long-term time period holding. They're currently holding Kalyan Jewellers 100 shares at 106 rupees and India Mart 10 shares at 1,960 rupees. What should they be doing with both of these? Continue to hold or maybe look to exit?
Again, both the stocks have really done well. As far as Kalyan Jewellers is concerned, I think in the last 1 month or so, the stock has gone up by more than 50%. But I would still maintain a hold. Most of these jewelry stocks are doing well. I think we are seeing positive impact of the ban on 2,000 rupees currency notes. Plus, there are during the wedding season, most of these jewelry stocks normally do well. So Kalyan Jewellers at this price can be held on to. And as far as India Mart is concerned, again, a good stock to own. The stock has corrected from its highs, but the investors bought it at a good level. So I think this stock also can be held on to from a medium to long term perspective.
On and Kunal, the next query is from Ram from Trivandrum, and he wants an advice on two counters. Firstly is 150 shares he is holding of Chemplast from a price of 666 rupees, and he also has Nalco 1300 shares from a price of 121 rupees. What's the outlook going ahead? Should he hold, average or exit?
So Nalco, I would suggest to average out at maybe start at current levels, but I think the stock could probably correct towards 86, 88. That could be another better level to average out further for Nalco. But just in case if the stock doesn't go into a correction, you should not be able to miss out. And that's why you can start at current levels and keep some allocation free in case if it dips towards that range of 86, 88. For Chemplast also, on the other hand, I would suggest to hold on to the stock, not to add, because the stock is still into a drag. Over the last, I think, 4-5 weeks, the stock has corrected from 500 odd levels to now 430, 435 where it's trading. But there are no signs of a major recovery into the stock price. The indicators are a bit below the neutral territory for Chemplast. So I would expect that this consolidation or the drag may continue for some more time for the stock. So a better timing-wise opportunity could originate for Chemplast maybe in the next 3 to 4 weeks. So as of now, just hold on to the stock. But for Nalco is something which you can average at current levels and in the range of 86, 88.
Because this query is on alkyl amines, and Umesh from Bangalore is holding 1,500 shares at a price of 2,700 rupees per share. For a period of 2 years, should they continue to hold it?
Again, a fundamentally good stock. The stock did really well over the last 2-3 years, ever since we saw most of the chemical stocks doing well because of the China plus one strategy being adopted by the Western countries. So I think he's bought it at particularly at a good level and it's sitting on some profits, but I think he should continue to hold on to this and ride on for the profits.
Moving on to the next one, and Vikas, the next question is from Dasar Radi from Vijayawada, and he wants to buy shares of Just Style at the current market price. So, what's the outlook? Should he enter in this particular name?
No, I would not advise him to do so. I think there are better opportunities elsewhere. So I would like to avoid this stock at the current levels. The valuations look expensive, even in spite of the fact that the stock has corrected from its highs. I think still at the current levels, the stock looks expensive. So I think there are better opportunities elsewhere. So he should not consider buying into Just Dial at the current levels also.
Kunal, the next one is coming from Mahesh from Delhi. They are holding Interglobe Aviation 15 shares at a price of 2,455 rupees. Should they continue to hold or exit? The time period is around 6 months holding time right now.
Hold on to the stock. Again, a consistent performing name. I remember post-COVID also the stock had recovered quite well. Last 3 months, the stock has recovered from 2,000 levels to now almost on the verge of hitting that 2,700 mark. So consistent moving stock, has done reasonably well. All the stock is above all the major moving averages, 50 DMA, 200 DMA, etc. So I think no reason for you to exit the stock or look to book profits.
Okay, moving on to the next stock then, and the next question is from Ramamurthy from Bahrain, and Kunal, he wants in your outlook on ABB India. He's now sitting at a profit of 26%. So at this point in time, should he book profits or stay invested?
Well, I would suggest to stay invested. Now, I understand that the stock has gone through a sharp correction, I think yesterday or day before. But I would believe that the stock has this tendency of trying to retest the 50-day moving average, spend almost a week or so at those levels or slightly below those levels, and then make a good comeback for itself. And historically, we've seen the stock even making or breaking the previous highs for itself. So I think in that anticipation, I would suggest a hold on ABB India.
Because R. Kumar from Kolkata has a couple of stocks. One is BEML. They are holding 200 shares at 1,660 rupees, while they have G Shipping 200 shares at 740 rupees. How is it looking for the long term for both these stocks? Should they continue to hold it? And what would be a target that one should keep for both these stocks?
Now, again, fundamentally, both the stocks are good. And as far as BEML is concerned, the stock is doing well of late. And I think there is further upside left, and would advise the investor to continue to hold on to it. He should give it some more time and should ride on the profits which he would get. And as far as GE Shipping is concerned, most of the shipping stocks are doing well, but the better ones would have been the PSU shipping stocks which cater to the defense sector. This is a shipping player, but I think my choice would be stock like a Cochin Shipyard or a Garden Rich Shipbuilders. I like them better than or more than GE Shipping, but GE Shipping also is doing well and can be held on to. But I think if he gets an opportunity, he could switch to a stock like a Garden Rich Shipbuilders, which would be, I think, which would give him better returns than GE Shipping over a medium to long term.
Okay, so that's the take. But moving on, and let's focus to JSW Steel numbers now. Now, this company is a part of the Nifty, and what we are seeing, stellar set being reported by the company on all the parameters. The numbers are seeing an improvement, or rather a beat across all the parameters. Firstly, let's talk about the profit. The company has reported a profit of this time around over 2,000 crores, 2,338 crores is what the company has reported. A revenue jump of 11% on a YY basis is what we have seen at 42,213 crores. Even on the margin figure, 16.7% is what the company has reported versus the estimate of 13.4%. So that's the beat coming in on JSW Steel across all the parameters. We are seeing a good run up, where the company also says that the crude steel production for the quarter is inched up higher to 11 on a YY basis, while it has been a muted set on a sequential bit of a performance. So that's why we are seeing great set of numbers from JSW Steel. But if we look at the margin figure, then on a sequential basis, there has been a dip of just 20 basis point from 16.9% last quarter. This time around is 16.7%. So great run up. So let's take the analyst take on this one. Maybe Kunal, firstly onto the charts, if you can help that how JSW Steel is looking like. We are seeing a jump of 2.5% right now, more than that. So any next stops for this one?
Well, I think it's an excellent chart because I remember, I think, that this is one of the best performing stock from the metal names, large cap wise specifically. So I think at current levels also, I would expect the stock to, head up higher. But it's just that, what happens is post results, once the news flow is out, once the event is out of the way, the stocks, they generally get into a bit of a profit booking mode. So even on good results, we expect that the stock moves up higher initially, and then there's some sort of a profit booking which emerges into the stock price. But net, the direction gets set from these outcomes, and that remains on the upside for JSW Steel. So you might look at some correction, but I think on the medium term wise, I would expect a big uptrend to continue for JSW Steel.
Right, big uptrend to continue for JSW Steel. And I'll just quickly, before we slip into the break, let's look at the quarter-on-quarter numbers as well, because revenues are down by 10%, EBITDA is down by 11%, and while when you look at it in terms of overall the profits of the company, that's down by 36% as well. As of now, given the current scenario that is going with the commodity prices, sometimes you could even compare on a quarter-on-quarter basis, and that would be a better understanding as well, and that is what is flashing on the screens for you all as well. So keep an eye out on the number. Yes, we did see a sharp run-up. Now, seems like that high that we saw of the stock, that's coming down as of now, but keep an eye out on the numbers. YOY, strong beat coming in there. And let's sip it to break. Welcome back, and you're watching Buy Now, Sell Now on ET Now, and it's Friday, so we do have the BNSN Pathshala for you all, and Kunal is standing by to give us some information in terms of pennant formation of price. On price, what is that, Kunal? What does this mean? What does this technically indicate?
So yes, Srishti, yes, Vinny, and pennant formation. So we discussed flag formations or flag charts, price formations on the previous session, and it's more of an addendum to what the flag formation is all about. So when prices go into a contracted range after a rally, that's where we call that the formation is more on the pennant side. So we look at a very classic example for how the pennant formation is. The stock goes into an uptrend where it moves up higher, goes into a steady uptrend, and then comes a phase of consolidation. Now in this phase of consolidation, what is important is that the stock consistently makes a pattern of lower highs as well as makes a pattern of higher lows, which means that the range is contracting for the stock price, and this is what we call as a classic consolidation or a triangular pattern. And when the stock breaks out over here of this consolidation, we expect a big breakout. So the way in which the stock enters into that consolidation is the way in which the stock exits or comes out of the consolidation. That's a breakout for formations. Now I've taken two examples over here, and the more important part for flag formation as well as pennant formation is the volume setup. So this is a classical example, a stock moving from 2150 odd levels to 2600 in a very short span of time, then getting into a consolidation. As you can see in this consolidation, the stock forming a pattern of lower highs and then a pattern of higher lows for itself. The moment the stock breaks out, we see a strong burst on the upside for the stock, and it then continues to move up higher significantly. In this phase of consolidation, the volumes drop by as compared to the volumes which happens post the entry of the stock into this upward trending range. So again, this is a classical chart for stock prices where we expect a consolidation and then a breakout. The second example is more intriguing because here what we've seen is that the stock enters into a breakout, gets into a consolidation, very tight band of consolidation, but the volumes are significantly high, which means that this is a much more powerful breakout in terms of charts. And whenever the stocks get into such kind of a breakout, look at the breakout candle over here and the volumes which were attributed on this breakout candle, which was exceedingly high. These are the kind of stocks which go into much more stronger phases of rally on pennant formation. So a classical observation tells you that how you have to wait out for that consolidation and that breakout and how to spot it in terms of volumes as well.
Thank you so much, Kunal, for today's Buy Now, Sell Now Pathshala. So that's what the learning was, that how to look at the breakouts and with the kind of a volume jump up, how to spot the exact breakout for yourself. But with this, let's also have a look at what the markets are up to. So no substantial recovery from the day's lowest points right now after the the initial fall we have seen. Nifty is trading down by 190 odd points as of now, and Bank Nifty is also near to that 46,000 level, but at least for now it is trying to hold on to that particular level and trying to defend that as well. Talking of some of the gainers in Nifty 50 now, so L&T, JSW Steel after a strong set, Adani Enterprise and SBI are supporting the index as of now, but on the flip side, the IT continues to be the biggest drag. No recovery from the lowest point of the day, and that's what remains the big story, wherein after the guidance cut by Infosys, the other companies have remained non-committal about where they see the revenue growth headed, what went wrong and what's in the store. Anisha joins in to break it down for us. Take it away, Anisha.
Well, the Q1 earnings of IT sector have been marred by the ram downs, on account of which the revenue execution has been weak. The other trend that we have spotted is the reduction in the headcount and the fact that the companies had to delay, defer or at least cut down on increments as well. The deal pipeline actually has been quite strong. Deal wins across the board, the numbers have been quite substantial, but nonetheless the managements are non-committal about recovery. They are not talking about whether there will be recovery in H2 or not. Let me substantiate all of this with numbers as well. First up, let's take a look of how the constant currency growth has been on a sequential basis for a lot of these companies. And there you have it from the likes of Persistent, Coforge, Zensar, etc. When we're used to seeing a growth of anywhere between 5 to 8% in the earlier quarters, that has scaled down to sub 5%, 2 to 5% range. And if you look at the other heavyweights, Infosys, TCS, LTI Mindtree, HCL, Wipro, they've actually reported a decline there. LTTS declining by as much as 3%. So the pace of revenue growth has definitely slowed, because remember, even the large cap IT companies were at least growing to the tune of 2 to 4% per quarter. So substantial reduction there. Similarly, if you look at the trend of the headcount as well, a lot of companies have actually reported a headcount decline. If you look at the total, 12 to 15 companies that have reported numbers, more than half has actually reported a decline. Let's go to the next slide, please, because that will tell you that the likes of Wipro, etc. have taken a headcount decline of as much as 9,000 employees, Infosys 7,000, even the other larger ones have taken a sizable hit. Not just that, going forward as well, they are non-committal about recovery. If you look at Coforge, L&T Tech, HCL Tech, Mastech, they've tried to maintain their guidance, though there's a bit of disbelief when it comes to HCL Tech, whether they'll maintain their 6 to 8% guidance. L&T Tech is very confident about recovery in the second half. Infosys, of course, has slashed that guidance by a whole lot. LTI Mindtree is saying that double-digit growth is challenging. TCS has pretty much said that they're looking at 8 to 10% growth, and Wipro too has given a very weak outlook as far as Q3 is concerned, telling you that there is quite a bit of reduction as far as overall growth is concerned, and that's quite evident by the commentary as well. Double digit is a tall ask, double digit is challenging, delay in discretionary spend, growth may pick up, they're not committing about it, and deal executions have been pushed to FY24 end. All of this has been the flavor as far as Q1 FY24 earnings are concerned. Having said all of that, the deal win isn't really bad. That's telling you that still deal signings are happening. So on a quarter-on-quarter basis, Coforge has reported a big bump up in terms of deal wins. Emphasis nearly doubled their deal wins. The others also have reported a decent number. Of course, for the likes of HCL, Wipro, there has been timing issue, and there we have seen a bit of a reduction, and Persistent also said that there was delay in decision making, but deal wins by and large have been all right. And all of that brings me down to the valuations, because if you look at the valuations versus the 5-year average, they are at par or slightly higher than the 5-year averages, but if you compare it with the 10-year averages, there's still some room up, upside available as far as valuation is concerned. So overall, the valuations are ripe in the sense that they are close to the historic averages, but of course meaningfully off the highs that we had seen during the COVID times. So for IT sector, glass half full or glass half empty.
Absolutely, Anisha. Thank you so much for that update. But with that, we're absolutely out of time on this edition of Buy Now Sell Now. It's a goodbye from Shrishti, myself, as well as the team who put this show together.